if I had $5,000 to invest in Australia right now, here's what I'd do. So I've written them down on this tiny piece of paper because I've got a lot of questions about this. The first thing that I would do is I would obviously make sure that I have like an emergency fund, and I wouldn't invest $5,000 if I had a $5,000 car bill that I needed to pay, right? Don't invest anything that you might need, and typically we say you might need in the next 3 years. So if you're gonna buy a house, if you need the money to pay bills, do not invest the money. And it might sound like really, I don't know, conservative, but actually it makes a lot of sense, because if you invest that money and then you need to pull the money out, you might have made a great investment, but because you're a forced seller, which is like the worst thing you can be, it's not going to work. So here are some ideas. With $5,000 in Australia, you can use platforms like Perla, which by the way does sponsor our podcast, Beta Shares Direct, which also sponsors our podcast, even Self-Wealth $9.50, Stakes like $3. You can use these platforms and you can get access to a lot of investments really cheap. Obviously read the PDS and make sure it's right for you. But I would start with $1,000 in the S&P 500. That's IVV, the iShares S&P 500 ETF. Reason being, you get 500 companies, world's best companies in the United States, everything from like Apple and even Tesla, like this bloody thing, right down to, you know, small companies or smaller companies by US standards, might be like Home Depot, or companies like Cloudflare, or companies like Berkshire Hathaway. They're all in there. So go and check that out. The second thing I would do is a bit different. I'd also stay in the US. So this is my second $1,000. I would explore an ETF like FHNQ. So I'm pretty sure that's the sticker symbol off the top of my head. I just wrote it down here on my chicken scratches. FHNQ, this is the FANG ETF from GlobalX, but with a twist. It's got currency hedging. Because you're investing from Australia into the US, you get the impact of currency. And the Australian dollar is actually very low right now, if you don't know. And so if you were to invest in the United States, even if you made a good investment over there, like you picked a good stock or a good ETF, if the currency, like the Australian dollar, goes up, it means your US dollars would be worth less in Australian dollar terms. So what we do is we use a hedged ETF. This is not a hedge fund, it's a currency hedged ETF. So it's the same ETF, just with the currency impact neutralized. Full disclosure, GlobalX sponsors our Australian Investors podcast. I'm not paid to say any of this stuff, just so you know, but obviously the Rask network's pretty big right now. So we do have a lot of advertisers on our platform. So I would put $1,000 in FHNQ. That's the FANG plus ETF that's currency hedged. What does this do? It invests in the biggest, basically the 10 biggest technology companies. So I'm talking things like Apple, Amazon, those types of things. The reason I would use this is because we're tilting our $5,000 portfolio towards the big companies. So just the 10 big ones in there, obviously. We already have the S&P 500. So what we're effectively doing is we're saying we like the broad 500 companies that we get with the S&P 500, but you know what? We're going to juice it a little bit more, and we're going to focus on some tech stocks. And the reason is I actually think AI is going to be a massive, massive thing over the next 10 years. And companies like Alphabet, that has Gemini Pro, Meta, which / Facebook, which has Llama, Microsoft is the biggest shareholder of OpenAI. Who else are going to? Apple's about to roll out Apple Intelligence for iPhones, just like this one. Amazon is basically powering the cloud plus AI through its AWS network. You've got like Tesla in there, like this thing right here, which is obviously going to use Elon Musk's XAI eventually and use AI in the car. So I think like you're getting a lot of exposure through that. Now I'm conscious of time. The next thing that I would do is the Vanguard VAS ETF. This is the ASX 300, so Australian shares, super low cost. Full disclosure, we invest in this one in our Rask Invest platform. We also invest in IVV in our Rask Invest platform, just so you know. So I'd put $1,000 in that. That's the top 300 companies in Australia, CommBank, BHP, all the usual suspects. We'll return franking credits as well. So that's good for me and for you. This is going to be a bit controversial, this fourth one, because you'll be like, oh, that's kind of boring. I would go, where is it? I would go with AAA. AAA, yo. So AAA is from Beta Shares. This is going to sound boring. This ETF just puts your money in a high interest term deposit, basically. So if you think about this, right, you have cash. This is AAA. It just invests in like cash. It pays interest monthly. But my idea is, if you're worried about like IVV, FHNQ, or VAS, I'm pretty sure it's back to front for you. Anyway, if you're worried about those ones going down, some people get really spooked about, oh, the stock market's near an all-time high, and then the narrator's voice is, it's almost always near an all-time high. That's because the stock market goes up. But anyway, if you're worried about that, a lot of people are like, oh, well, I just won't invest now, which is shown like 100 million times over to be the stupidest thing anyone can do. So don't not invest, just invest in a diversified portfolio. And then what you do is, if, say, for example, the US stock market falls, you just take the cash that might be in this one, even though it's paying you interest right now, right? You just take that cash and you put it into those two. So, or that one. So it's a classic rebalancing. You still have your investments that are growing. You know that it might be a little bit expensive. You know, on average, the stock market falls once in every 5 years. I showed that in the other video I did. But you can still invest. Just take the money out of here when these ones crash and take it from here and put it in there. That's all a professional investor like I would do. So anyway, hope that makes sense. All right, so we've got $4,000 of our $5,000. Now it's going to be a bit more fun. It's going to be a bit spicy. So I'm going to name two companies, or stocks. So companies are just stocks, or stocks and shares and equities. Those three things are the same thing. And all a share is a shareholding or an ownership of a company. So if I say like Rask here, my company, I'm the biggest shareholder in the Rask group. So they're just shares. The only difference is I own them and they're not on the stock exchange. It's the only difference. Okay, two companies. I would put $500 each in these. I would go with Wesfarmers. So Wesfarmers is the company, WES is the ticker symbol. Wesfarmers is the company, WES, is the company that owns Bunnings in Australia. It's the company, if you're from the United States and you're watching this, it's like your Home Depot. Wesfarmers, I would put $500 in. You get franking credits. The share price has performed really well recently. But the thing is, it's interesting about Wesfarmers, it's got like heaps of different businesses, like Officeworks, Kmart, a bunch of different stuff that it owns, all inside the one conglomerate, like the one big company. The thing about it is that's quite interesting, and apologies about the rain, if you can hear that. The thing that's interesting about Wesfarmers is that it's still gone up, even though interest rates have been quite high and the property market has struggled a little bit here in Australia. With interest rates on the way down, I think more people are going to be buying Bunnings sausages and going to spend money at Bunnings to then, you know, they won't be paying as much on their mortgages and property investors will come back. This one here, Costco. So Costco is a really interesting business. It's one of the few companies in the world that Charlie Munger, Warren Buffett's investing sidekick, and probably the better of the two, I think. It's one of the few companies in the world that he invested in. And when you look at Costco, it's not just a big supermarket. Most of Costco's profit actually comes from the memberships. So when you pay $60 or $50 to be part of their loyalty club, that's where most of the money comes from. And Costco is now investing heavily. When I say heavily, I mean it's like doing it really intelligently. It's investing heavily in things like travel, pharmacy, diamonds and precious metals, like gold and that sort of stuff. It's a wonderful, wonderful, wonderful business. And interestingly, they tell you this in their quarterly reports. The number of foot traffic, the amount of foot traffic in Costco stores worldwide is actually going up. So you might be thinking, well, Costco's going to be smashed by Amazon and all that sort of stuff over the next 10 years. I actually don't believe that. I actually think more people will, like big ticket items, will go and shop in store. And we're seeing that actually play out in Costco's data. The other thing is they're still growing, number of stores. And probably the one point that I always remember about Costco is the average retention rate. So the retention rate on a Costco member is 90%. 90%. If you're not up with maths, I'll do that the other way around. If it's 90%, that means 10% aren't staying. In other words, one in 10 people leave every year. Put another way again, in another way of finance math, is on average, a Costco member stays a member for 10 years. I think that's incredibly sticky, loyal customer retention. Wonderful business. Got some ETFs. Remember, this is general financial advice only. I don't know your needs, goals, or objectives, so do not invest until you speak with a financial planner. And be sure to read the PDS available on the ETF provider's website.